Inflation is no longer exploding, but it is not disappearing. Prices have stabilized, yet the cost of living remains elevated. For households, the pressure has not vanished. It has become normal. That shift matters more than headlines suggest, because inflation does not hurt most when it rises. It hurts most when it stays. Persistent costs change behavior. Consumers become selective, businesses become cautious, and markets become sensitive. Right now, the Federal Reserve is watching carefully, not reacting quickly, watching. Interest rates remain elevated. Borrowing costs are still restrictive. Credit is available, but not cheap. This affects every part of the economy. Housing demand remains limited. Mortgage rates are still high. Affordability remains low. Existing homeowners hold on to low-rate loans. Supply remains tight. Prices remain sticky. Housing does not collapse, but it slows. And when housing slows, economic momentum slows quietly. Now consider consumer spending. Spending is still happening, but patterns are shifting. Essential purchases continue. Discretionary spending becomes selective. Households prioritize stability. Savings are used carefully. Debt is managed cautiously. Credit card balances remain elevated. Interest payments are rising. This reduces flexibility. Not immediately, gradually. Gradual pressure is harder to notice, but more difficult to reverse. Businesses are adjusting as well. Hiring is more selective. Expansion plans are delayed. Inventory is managed tightly. Profit margins are protected. Efficiency becomes the priority, not growth. The labor market remains stable, but momentum is softer. Job creation continues, but at a slower pace. Wage growth is stabilizing, not accelerating. This helps inflation, but limits spending power. Now look at financial markets. Stocks remain elevated. Indexes are near highs, but volatility is increasing. Markets react quickly to new data, inflation reports, employment numbers, Federal Reserve signals. Each update moves expectations. Expectations drive prices more than reality. That is why markets feel unpredictable. Now consider interest rates. High rates control inflation, but they also slow growth. This creates a delicate balance. Cut rates too early, inflation may return. Keep rates too high, growth may weaken. The Federal Reserve must choose timing carefully. Timing is the most powerful tool in monetary policy. Not speed, not size, timing. Markets are waiting for clarity. Investors want direction. Businesses want certainty. Consumers want relief. But clarity takes time. Economic cycles do not change instantly. They evolve, slowly, quietly, often unnoticed until the shift is complete. Now consider global factors. Energy prices remain volatile. Trade relationships continue adjusting. Geopolitical tensions remain present. Supply chains continue adapting. These forces create uncertainty, and uncertainty affects investment. Investment drives growth. Growth supports markets. Confidence connects everything. Without confidence, spending slows, hiring slows, investment slows, markets react. Confidence is the hidden driver of economic stability. Right now, confidence is stable but cautious, not optimistic, not fearful, cautious. This is the stage between expansion and slowdown, a transition phase, not crisis, not boom, transition. In transition periods, small changes have large effects. A slight increase in inflation, a small decline in employment, a modest policy shift, each one can change direction. That is why data matters now more than ever. Watch inflation, watch employment, watch consumer behavior, watch credit conditions. These indicators move first before GDP, before markets, before headlines. The U.S. economy in late March 2026 is resilient but sensitive, stable but stretched, growing but cautious. The next phase will not be decided by one event. It will be decided by accumulation, small pressures, small adjustments, small decisions over time. Markets do not collapse without warning. They weaken gradually, then react suddenly. Understanding that process is how risk is managed and opportunity is recognized, because the future of the economy is not determined by fear, it is determined by balance. Balance between inflation and growth, between policy and behavior, between confidence and risk. That balance is being tested right now, and markets are watching closely.